Hi, are you and your clients feeling somewhat overloaded by all of the information that came out of the May budget? Today we're going to look at negative gearing and unpack some of that. So I'm Joanne Hotston, I'm a chartered accountant and I'm also a chartered tax advisor. And this program hopefully will just sort of chunk down some of the main questions about negative gearing, what you can do and what you can't do. And of course, where are we up to with all of this? Well, technically, as I film this on the 8th of June, we do not have legislation. We do have a bill that was introduced into Parliament, and that bill covers not all of the budget announcements, but it does attempt to cover CGT changes, which we will look at in another program, and negative gearing, which we'll look at today. And then it also has the much more simpler changes in relation to the new Working Australia tax offset and the standard $1,000 deduction. So currently, that's all we have seen any proposed legislation in relation to. So some of the more difficult stuff is yet to come. So today we're going to do negative gearing. So of course, most important question, what stays the same? We as human beings like to know what stays the same. Well, negative gearing will remain for people that had existing properties as at 7:30 p.m. on budget night being the 12th of May 2026. And that will also include vacant land. Having said that though, there are some specific rules around vacant land which do limit some of the deductions, and that's legislation that's been with us since 2017. But the general grandfathering premise is your client, or maybe you, owned some sort of residential rental property prior to budget night. You're making a loss from that, which is what we call negative gearing, and you will continue to get the benefit of that loss even after all these changes are legislated. The other thing that doesn't change is if clients want to negative gear share portfolios, then whether they had those shares pre or post budget night won't be relevant. Negatively geared share portfolios, those deductions will continue to be allowable. If you want to negatively gear commercial property, there's no changes there either. So it's just residential properties that are really targeted here. If you have widely held trusts, and most of you probably don't have widely held trusts, but if widely held trusts have geared property in them, be it commercial or residential, they continue to get their gearing. And good news, super funds, and in particular, most of you looking at this are possibly more interested in self-managed super funds. If your client has a self-managed super fund and they wish to take out a limited recourse borrowing, and maybe that property is negatively geared, they will continue both before and after budget night to be able to get the effect. So one thing out of this budget was no changes to superannuation. That's always usually quite good news. All right, so the grandfathering will be properties such as your main residence that you owned before budget night, other residential properties that you might have owned but maybe not rented out. So you rent them out in the future, which then makes your interest deductible. You'll be able to get those losses. And vacant land, as I said, potentially, if you own the vacant land prior to budget night, that also gets what we call grandfathering. So the existing rules that were around prior to the 12th of May will just continue. Now that then leads us to the next question of what changes from the 1st of July 2027? Now remember, the whole kind of policy intent behind the May budget was to increase housing affordability. Whether these changes actually do increase housing affordability, that's not really for me to say on this program. I'm just going to tell you sort of the policy behind it. Sometimes if you understand policy, it sort of make changes make a little bit of sense. But from the 1st of July 2027, now that's a whole year after the budget was handed down, any properties which were acquired post 7:30 p.m. on the 12th of May, if they are residential properties, you will not be able to use the loss from that negatively geared property. So there's obviously no grandfathering, but there's this odd little thing that someone buys a property today, June 2026, it's a residential rental property, it's geared, and between now, so for the 2026 year, and before the 1st of July 2027, they will actually get the benefit of their gearing. So the quarantining of the negatively geared loss only commences when this legislation commences from the 1st of July 2027. All right, now I often get asked the question, well, what if I own several properties? Some of them are geared and some of them aren't. Well, the good news is you basically add together your property's net result for that financial year. We'll assume this is after 1 July 2027. And if that is a positive number, the ones that effectively had a loss, those losses are being offset against the positively geared properties. So we don't have to quarantine the negatively geared properties individually. So that's possibly some good news for those taxpayers who may own more than one property. Then, what is accepted? So I always say tax is easy. It's just the exceptions to the exceptions that cause people to come unstuck. If you invest in new residential properties, then the gearing on new residential properties will be allowed. And again, that fits into the government's policy of trying to increase housing stock and make housing more affordable. So if your client wants to invest after the 12th of May, after budget night, in new residential and it's geared, then they will get the benefit of that gearing loss, and that gearing loss can be offset against their other income, which might be wages, salary, interest, etc. That then leads us into, though, what is the definition of new? And this is where this starts to get a little more complicated. Eligible new builds, you can have your quarantining loss. Newly constructed apartments bought off the plan. A duplex, which is constructed through a knockdown. So we buy an existing house, we knock it down, but we build more than one residential premise on that land. If we just knock down a house, build a new house, that will not be new for these purposes. Any residential construction on vacant land that you owned, whether it was prior to budget night or after budget night, that will be new residential. And newly built properties which are occupied for less than 12 months before they are actually sold. Now, those of you who know anything about GST will know that there's a definition of new residential in GST, completely different definition. So don't go, oh, that's a 5-year rule in GST. Yeah, it is, but these are completely different rules. Now, what does not constitute an eligible new build? Which means if someone acquires it after the 12th of May, they will have to quarantine their losses. Some of this is then sort of says in the reverse what I've just said, but an established property that has recently been extended. So I did hear someone say on social media, doing a renovation makes your property new. No, it doesn't. A freestanding house constructed through a knockdown and rebuild, not new unless you create more than one dwelling. A granny flat, well, the granny flat might be new, but if it's built adjacent to land on an established property that is not eligible for negative gearing, then the granny flat's not going to get negatively gearing negatively gearing losses. They'll have to quarantine them. And a newly built property, which is occupied for more than 12 months. So that area starts to get slightly more complicated. So let me just summarise. When can you have your negative gearing? So just going back to the beginning, residential dwellings that are not subject to quarantining are those which are new, those which had been acquired prior to 7:30 p.m. on the 12th of May, and those that are held within widely held trusts and complying super funds. I'm just going to mention, and for my last slide, there is a so-called integrity rule here, where if you have someone who borrows money from the bank and they buy shares and their net return from their shares every year is less than what they pay in their interest expense, remember I said you can you can negatively gear your share portfolio. However, if your client has a unit trust which has a whole bunch of properties in it, and the trust itself is not a widely held trust, so we're not doing the gearing at the trust level. We have our unit holders who are the investors, maybe that's mum and dad. Mum and dad gear their units in this unit trust which holds residential properties. Mum and dad are not going to be able to get potentially the benefit of their quarantined, their negatively geared losses will be quarantined going forward. So we have a difference between gearing in shares and gearing in unit trusts. So this is what they refer to as a so-called integrity rule. That's the end of what I wanted to do today for our tax snack on summarising the negatively gearing provisions. In another tax snack, we'll move on to CGT. We'll probably come back and revisit some of the trickier things to do with negative gearing, about when is a unit trust a holder of residential property, etc. Thank you for watching today. Please be mindful of today's presentation is not specific tax advice. It is generic in nature. You should always consult your registered tax agent for your own specific tax advice. So this is general. I'm Joanne Hotston, and thank you for watching our program today.